Mortgage rates just fell to their lowest point since the middle of May. Here's the part most people miss. It happened in the same week the government's main inflation report came in at a 3-year high. That's not supposed to happen. Today, I'll show you why it did and what it means for the guidance your clients are looking to you for. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of June 26, 2026. Let me start with the big picture, then break it down. Rates moved lower this week, and the bond market did most of the heavy lifting on Thursday. As we record this, the market is still open, so nothing is final, but the 10-year Treasury yield sits at about 4.37% right now, down from 4.46% a week ago. That drop is the engine behind lower mortgage rates. So why did rates fall in a week with hot inflation? The inflation report, called PCE, showed prices up 3.4% from a year ago. That's the highest reading since October 2023. On paper, that sounds bad for rates, but the market looked right through it. A big piece of that number came from older, higher oil prices. Oil has since dropped back under $70 a barrel, right where it sat before the Iran conflict. Lower oil today should pull inflation lower in the months ahead, and traders are betting on exactly that. Here's what to watch underneath the surface. The economy looks fine on the top and softer below. First quarter growth was revised up to 2.1%, but when you dig in, most of that came from fewer imports and government spending, not from the consumer. A cleaner read on real demand actually slipped from 2.4% down to 1.7%. On the job side, first-time unemployment claims are still low at 215,000. But people are staying on benefits longer. Continuing claims hit a 3-month high near 1.82 million. A softer economy tends to be friendly to rates, and that is part of this story. What about the road ahead? One outlook we follow expects the 10-year yield to keep working lower and test 4.2. The logic is simple. Oil has returned to pre-conflict levels and home building has stayed soft. Both of those tend to push rates down. Nothing is promised in this market, but the wind has shifted. Now to this week's rates. These are national averages from Mortgage News Daily, not an offer to lend. The 30-year conventional, 6.53%. The 30-year jumbo, 6.77%. The 30-year FHA is 6.1%, and the 30-year VA is 6.12%. All of them are sitting at or near their best levels in more than a month. This is a good moment to remember a simple idea. Strategy beats rate, always. That brings me to something many of your clients need and do not know to ask for. Some of the strongest borrowers you know have tax returns that do not tell the whole story. Business owners, self-employed clients, people who write off a lot of income on paper. On a standard loan, that paperwork can work against them. We carry a selection of loan programs built exactly for these situations. The first one to know is the bank statement loan. It looks at real deposits coming into the bank, not just the bottom line of a tax return. If you have a client who earns well but shows little, this is the program to remember. You can learn more at rsrlinks.com/bankstatement, rsrlinks.com/bankstatement. We also shared a set of pieces this week that your clients will want to read. First, home prices are rising in 71% of the markets. The crash you were promised isn't coming. Next, overpricing your home costs $19,000. Here's the math that proves it. Next one, your credit score sets your insurance rate. Here's the math most people miss. Next up, here's what nobody tells you about selling your home until it's too late. And finally, your 90-second AI trust could send your family straight into probate. There are more on the dashboard. You'll find them all on the right side of the dashboard or below the video, depending on the device you're using. One more free tool to share, KeySteps, is a free platform offering credit monitoring, identity theft protection, and household budgeting tools all in one place. Visit rsrlinks.com/keysteps to share it with a client. Next week is a short one with markets closing early ahead of the 4th of July. It is also Jobs Week. We get the ADP private jobs report on Wednesday, along with ISM manufacturing and a speech from Fed Chair Warsh. Then on Thursday, the big one, the monthly jobs report. Forecasters expect about 172,000 new jobs and an unemployment rate of 4.3%. Watch those numbers closely. A softer report would keep the friendly tone in the bond market going. This is your weekend update. We appreciate you listening, and we'll speak to you again next week.